Okay, in this video what I'm going to do is take you through one of the topics of the weekly macro themes report. This report is basically the core sort of flagship report of our institutional service. It goes alongside the Markets Monitor, the Market Cycle Guidebook, and the quarterly strategy pack. So what this report does is basically looks at 5 different ideas each week. As you can see there, it's a combination of stuff from macro, specific asset class, risk or return or sort of opportunity clarification. So what we're going to do in this video is go through topic number 2. So US versus global ex-US equities, but you can see there some very interesting topics also, particularly in that space, also looking at emerging markets, frontier markets, commodities. That's a really good topic there too, that one. If you're interested in that one, definitely get in touch and I'll send you a copy. But for now, let's just go straight into this one. US versus global ex-US. We'll start here with the bottom line. Reiterate bull case for global ex-US versus US equities given the compelling valuation case, long-term expected return differentials, and political/regulatory tail risk, which I will talk about lastly. So we'll talk about the valuation case first and then go through some of those other aspects as well. And on the valuation case, look, it's pretty much the same conclusion no matter how you cut it. Looking at the price to book ratio chart there for the US, you can see the price to book is pretty elevated, versus its own history, and very substantial gap between global ex-US. And so global ex-US, just to clarify what that actually is, so that's all of world equities, but basically really just emerging markets and developed markets, excluding US. So, developed ex-US still makes up the dominant portion there. Emerging markets has been growing over time, but developed ex-US, and so that's like, obviously Europe, UK, Japan, Australia, Canada, and then some of the smaller countries there as well, but especially also in emerging markets, it's China, India, Brazil, Russia, so on and so forth. Blended PE ratio across countries, so you can see there for the blue line there for global ex-US, this time I've actually just taken the median rather than the weighted average, which is on that one to the left there. This blended PE ratio there, that is the average of the forward price to earnings ratio, so price versus consensus next 12 months earnings, price versus trailing earnings, so last 12 months PE ratio, and the PE10, which we'll get to in a second, price to trailing average 10-year earnings. The point of using a blended PE ratio is to try and maximize the signal and minimize the weaknesses or the noise of each of the individual different types of PE ratios that go into that. I've written sort of fairly extensively on this elsewhere that, times like the situation that we're going through now, forward PE is very misleading, while the PE10 is, gives you quite a, probably the best signal, or the best of any, at least, to go by in terms of providing, some sort of basis for coming up with a valuation conclusion. So anyway, as you can see there, global median, pretty much at the long-term average there. It did get very cheap back in March, but has since come back quite sharply. US, on the other hand, has actually gone up to a new high. This was from a couple of weeks ago, so that's actually gone up even further since then. But also just significant gap between the two there, and that's kind of like the bottom line here, kind of the punchline really. And PE10 there, just to round it out, and that's for global ex-US, that's the weighted average PE10, and you can see there that it's it's lower versus its longer term history. You might debate about whether it actually can ever get back up to those sort of 25 to 30 levels. Probably will one day, but in the immediate term, even just going up to sort of that 15 to 20 range there, the upper end of that range would be quite meaningful from a return standpoint. But anyway, In terms of absolute valuations there, it's fairly clear and quite robust, or it's true no matter sort of what indicator you use, PE10, blended PE, price to book. Now on that blended PE ratio, just before we go into the equity risk premium, what I've done with this chart is quite a unique, interesting, kind of cool chart here, is to look at the breadth of PE ratios, or the breadth of valuations. So that again is across those 47 countries, and it's in the sort of lime green colour there is asking how many countries are cheaper than the US, and you can see there that it's almost 100%. So almost every country is cheaper than the US. Certainly more than 90% of countries are cheaper than the US, and there, if you go onto that sort of more of a traffic light green colour, countries that are at least 20% cheaper than the US, you can see that it's well above 80%, almost 90%. So yeah, and I guess the point of this chart here, or the value of this chart, is that if you look at the weighted average, you could say, well, yeah, but what about the composition? Is it being skewed by one big country or sector? And equally, I mean, the global median kind of helps cut through that, but you could still sort of make the same case there. But then looking at on the sort of breadth picture here, it makes it fairly clear that it's very much a widespread phenomenon, and it's more the rule than the exception, that most countries are outside of America are cheaper. And so equity risk premium here, so that is the way that I calculate it is I use a more, what would you say, reliable, less noisy way of calculating it. So using the PE10, the inverse of the PE10, to give you the earnings yield, a more smoother and reliable earnings yield, and then also using a more smoothed and less choppy and incoherent or inconsistent and noisy version of inflation as well, to get the real yield that you take away from that. But anyway, the key point here is that global XUS is, it has come down from March, but the equity risk premium is still very much elevated versus history. It's and again that has actually come down a little bit more since then, but it's still pretty much on par with the top end of the range of the past decade. US is it's not bad by any means, but it's certainly a lot lower than global XUS. It has also come down a bit since then. But yeah, it's just another lens by which you can see that global XUS is definitely cheaper than US equities, and also in this lens, offering better or significant premium over risk-free or quote-unquote risk-free government bonds. And then lastly, just a couple of sort of parting shots before wrapping this up. One thing to note here is the path of US versus global XUS relative performance. So, well, firstly, you can see that this relative performance has been quite extreme. Now, this is just relative price performance, so strictly speaking, it doesn't necessarily make sense to look at it in this sort of implication or implied view that there would be mean reversion. Mean reversion's quite a sensible sort of assumption for when it comes to valuations, so we do see this sort of mean reverting tendency here. But price, well, we'll just put it there for argument's sake. But the key point there is that the US dollar index, so the broad trade weighted index there, tracks fairly closely to the path of relative performance, and the reason for that, there's a few actually reasons that there. One is there's just straight up the translation effects. So if the US dollar is getting stronger, then from the currency's translation standpoint, because this is in US dollar terms, then that will mean that it's basically a headwind there. And so For example, if the US dollar weakened substantially, then performance of global ex-US assets, global ex-US assets could do 0% by themselves, but because of that currency translation effect, you'd get quite a substantial currency return kicker from that if you weren't hedging. So there is that aspect, but probably more meaningful is just the fact that you look at the currency. What does currency reflect? It reflects relative economics, and so it's pretty fair to say that the last 10 years the US has performed better than global ex-US from an economic standpoint. And it's not to say that it's been shooting the lights out by any means, but just avoiding sort of potholes that Europe has, for example, with the sovereign debt crisis there, or emerging markets with the sort of structural slowdown in China, and then also the commodity crunch and EM's near-miss global recession back in 2015. And then, of course, more recently also the trade war, which has put another sort of dampener on things there. But do expect that trend to reverse at some point. There is a lot of pieces of the puzzle sort of falling into place as we look forward from here. And certainly one way to look at that quantitatively is to look at the projection here on the bottom left chart. So this is a projection in that sort of light blue line there, and that's based on the capital market assumptions that we produce. The next update to those capital market assumptions will be next week, so the 1st of July. So that will be in the market cycle guidebook. We've expanded the capital market assumptions section in that report, so that's definitely worth checking out as well. And definitely also worth checking out just how much capital market assumptions have shifted since back in March as well. But one thing that hasn't really shifted that much is the relativities within the capital market assumptions. And so because global ex-US, the prospective forward-looking return data there is materially higher than the US, then you would expect them to outperform over the next 5 to 10 years. Obviously it's not going to be a straight line, and it could be that you sort of go up and then come down, or that you meander along and then come down. But another thing to note about this chart, which I think is really quite intriguing, is just how there appears to be these fairly reliable cycles of relative performance here. They last about sort of 10 to 15 years. You can see there in the 70s, early 80s, it was actually global that was outperforming America. And then in the 90s there, climaxing, culminating with the dot-com bubble, was the US clawing back its performance there. Then in the 2000s, there was this new sort of just really only about a 10-year cycle of performance there, where that was really about emerging markets, commodities, that sort of thing. And then this last sort of 10 to 15 years here has been all about bad times abroad and good times for tech. And that brings us probably to the last couple of points there. So political risk, regulatory risk, I think is definitely coming onto the radar from my conversations, from my surveys, from the anecdotes. Investors are definitely starting to pay a lot more attention to this, and as it becomes a bit more clearer, it could become a pretty key catalyst for this. And that's both sides of the table, both sides of the political spectrum. So looking forward to November, if you got a Democratic sweep, there's been a lot of talk there about tax reforms. Tax reforms is one thing that would include would be corporate tax reform, so potential unwinding of the Trump tax cuts there. So that would certainly put a short-term headwind there for corporate earnings. And then also, on the other side, Trump's obviously not very happy with the tech companies here, big tech. has certainly made some noise about cracking down, or it's certainly taking a closer look at regulations there. And then there's also been, I think, just in general, that sort of murmuring about antitrust law, and whether the likes of the super big ones have gotten too big, or and all this and the other thing. So I guess the bottom line there is we don't really know either way, and maybe the Dems wouldn't wind back those tax cuts, but maybe they would. It's kind of it's quite a big sort of unknown on both sides. So and probably that's kind of like the bottom line really, is the fact that it is unknown, it is a possibility. The uncertainty factor, that's pretty much the definition of risk, so that has actually gone up for America disproportionately to the rest of the world. And then you throw that on top of this sort of, the maths around the capital market assumptions, those valuation pictures there, and it starts to look fairly compelling, I must say, if I had to say it in a one line. Just lastly, we did post something on the blog last week, I think it was, about this, probably the most common objection to these sort of charts here. So the valuation charts is that they don't account for sector differences or industry differences, that sort of thing, or the fact that tech is US index has a lot more tech in it. But we have actually ran the numbers. I did a bit of an exercise of looking at basically neutralizing the sector differences, and certainly on PE10 ratio, US valuations do actually come down a little bit. They still look very expensive versus history, and on the global ex-US side of things, the valuation did go up a little bit. But it wasn't material enough to change the conclusion about global ex-US by itself in terms of its own history, and certainly the gap between them did narrow just a little bit, but there was still a very substantial gap. So it's not an invalid point by any means, but it's not material enough to change the conclusion. And so with that technical note, I will leave you there and return to the bottom line just to sum it up. So again, and pretty much understand it now, reiterate the bull case for global ex-US versus US equities, given the compelling valuation case, long-term expected return differentials, and rising political regulatory tail risk. And so this has given you a pretty good sort of high-level taste of what I'm doing with this kind of work and the way I look at things. So if you wanted to have a closer look at this report, you can go down, or just put the website there. You can see topdowncharts.com. Just go there, and if you click onto the subscribe button, and it'll take you to a bit of information about getting a free trial. And you can just click through, fill out the form, try to fill out as much information as you can, because if you only put your name there and it just looks like you're not actually a fund manager. So this is really mainly for fund managers, professional investors, sophisticated, blah blah blah. So yeah, please fill out the form with as much information as you can, and we will get in touch.